This show is intended for general purposes only, as individual situations may vary. Statements made should not be relied upon as recommendations or solicitation. When discussed, past performance is no guarantee or indication of future results. Nelson Financial Planning offers security through Nelson Ivest Brokerage Services, member FINRA, and SIPC.
Good Sunday morning. This is Bud Hettinger. Next on News Radio 93.1 WFLA, the longest running radio show in Central Florida, Dollars and Cents, with my good friend Joel Garris from Nelson Financial Planning. You can call him at the office this week at 407-629-6477 to schedule your free consultation to discuss your retirement plans, or you can talk to him right now at 407-916-5400.
Good morning, ladies and gentlemen, and welcome to the program Dollars and Cents. My name is Joel Garris of Nelson Financial Planning, and for the next hour, it's Dollars and Cents, where we help you make sense out of all of those different decisions that have anything and everything to do with your dollars. On the show today, we'll ask the question, do you know how the people who manage your investments, and I don't mean your advisor, I mean the portfolio manager of your fund. If you own a fund, do you know how that person is compensated and what their compensation is based upon? We got some interesting statistics that we want to share with you that may make you think about what might be a good metric or a good thing to know about the funds that you own. We will also tackle the conversation on the advisor side. We've touched upon this in previous programs. A lot of conversation out there in the industry about fee-only, fee-based, fiduciary, all of those kinds of things. We're going to have a lot more to talk about on those topics in the weeks ahead because we're working on something at the office that we have shared with our clients. We have not yet shared with our radio listener audience, but we will be doing that here in the next 2 or 3 weeks. And to talk more about that, to really set the stage for it, we're going to revisit this topic over the course of the next 2 or 3 weeks on the program. So stay tuned for that, but we'll kick it off this week with some interesting stats. And then we will also tackle some things that you should know about Social Security. This article actually comes to us courtesy of the Social Security Administration, and I don't think we've posted it on social media, but it's a good one. So I'm going to make a note right now, post on social media. Now, here's a little dirty little secret. I don't actually do that. I have a guy half my age in the office who does that, if you know what I'm saying. Anyway, and then before we get, of course, to all of that, well, I suppose we need to talk about the markets, right? I mean, you can't have a weekly radio program that talks to people about their finances and retirement and educating their kids and all of those kinds of things without talking about the market, particularly when the market makes the kind of negative headlines that it did this past week. It's funny, I don't know if it was last week's show or the week before, but we were talking, we gave you the following statistic that over the course of the past 10 years, since the market has sort of been in this recovery phase post-2008, the reality is that you have a period of time while the market has certainly gone up pretty dramatically from those lows back in 2008, 2009. Number one, you have 70% of the population believing that the market's been flat for the past 10 years or, in fact, down. That's perspective. That's perception. That's not reality, of course. what is reality is that along the way, there have certainly been periods of time where the market has declined anywhere from over 5 to 20% during that period of time. And if you count them up, there's 11 such periods of time where that, well, now after this week it's 12, but there is a normal pattern to the market because the market has inherent volatility. So you do run into this from time to time. What we like to remind people is to think of retirement and entering into retirement or approaching retirement as not some kind of an end, but rather the beginning of the next chapter. And if you stop and think about it, that really will consume about a third of your life these days, especially for a married couple that are age 65. One of you stands a very good likelihood of at least being here at 85, more likely now at 90. So that's a 20 to 25 year time frame that you need to keep in the back of your mind as it relates to your investments, particularly when we go through weeks like we just had. Okay? So if you think of it as it's almost, life almost divides itself up into thirds. The first third, you're a kid, you're a young adult, just trying to figure things out. The next third, maybe you've got it figured out, or like me, as I was saying to somebody the other day, the older I get, the more convinced I am that I don't have anything figured out, and just enjoy the process, enjoy life. And so, but that third is generally spent working and I guess sort of figuring things out. And then that last third is more those retirement years. And so if you think of it like that, look, folks, this is a marathon, if you will. It is not a sprint. And the unfortunate part is you get weeks like this, and it's Katie bar the door, if you will, from the media's perspective, because they're going to just keep whipping and fanning these flames that they've been hoping. The media always hopes for a decline because a decline gets people's attention much more than an increase. Okay? And so they're hoping that this is going to happen, and that way they can get everybody excited and everybody watching them. That's the reality. And the problem is, well, some of them do a decent job and distract people, particularly when you look at these statistics that say that 70% of the population out there thinks that the market over the past 10 years has been flat or down, when the reality is it's basically tripled, quadrupled by some measures. So that's a very different perception versus reality, right? So what causes that? What causes that is when we go through weeks like this and the media fixates on it, it says it's never going to end. It's just going to keep going down and it's all going to, turn into soup. Well, the reality is nothing ever is that bad or nothing ever is that good along the way. And ultimately, what it always comes back to is economic fundamentals. Those economic fundamentals, those things like consumer spending, corporate spending, those still point to some pretty strong numbers. And if anything, and we've certainly talked about this on the program over the course of the past month, a lot of volatility generally kicks up at this time of year, particularly in midterm election years. What did we talk about? I think it was 2 Sundays ago, or maybe 3 Sundays ago, the takeaways from a midterm election year. One of them was that volatility increases as you get closer to the election. What do we have? Volatility increasing as you get closer to the election. Once the election is resolved, that volatility has a tendency to dissipate. So don't overreact to what went on this past week in the market. We'll have some more thoughts on this and continue the conversation when we get back after this here on Dollars and Cents with Joel Garris of Nelson Financial Planning on News Radio 93.1 WFLA.
This is Bud Hettinger. You know, you can talk to Joel Garris of Nelson Financial Planning right now on Dollars and Cents about anything to do with your money by calling 407-916-5400. Give him a call. It's time to make sense of your dollars.
Welcome back to the program, ladies and gentlemen. Dollars and Cents here on News Radio 93.1 WFLA. Talking, of course, as you might well expect, on a financial show that is done on a weekly basis. Well, we were talking a little bit about the market this past week and trying to get some perspective. Remember, folks, it is a marathon, not a sprint. If you're at retirement age, guess what? You've still got another 20 or 25 years to go. So don't turn the apple cart upside down. Volatility, a normal part of the market. If you look at the past 10 years, there's been 11, now 12 instances of where there have been declines of between 5 and 20%. This is normal. This is not as the media describes. The media would have you think, okay, that this doesn't happen, okay, or when it does, it means catastrophe must be around the corner. That's their job because they want to get you hooked on the bad news because human nature is much more inclined to get hooked on bad news rather than good news. Of course, the problem is that you lose complete perspective along the way. Over the past 10 years, the markets have tripled to quadrupled, depending upon which index you look at. But yet you've got 70% of the population believing that the markets were flat or down during that time period. Where do you think that misperception comes from? Comes from the garbage that the media and the internet spew forth. Try not to pay a whole lot of attention to it. Yes. Is it always a good idea to double check your allocation? Absolutely. Absolutely. But you shouldn't be turning your allocation upside down during periods of time like this. Make some adjustments if you feel it's warranted. But at the end of the day, if you're 75% stock, 25% bonds, don't all of a sudden become 75% bonds, 25% stock. That's turning the apple cart upside down. Maintain some perspective on it. At the end of the day, this is all normal. It is not abnormal like the folks in the media and on the internet would like to have you believe. All part of the normal cycle. Be consistent. Stay invested. It is time in the markets, not timing to achieve investment results over time. And that should be your goal. It should not be, I'm investing this money and 1 year later I'm going to take it all out. That's not how it works. When you save money, right, you're working during that middle third of your life. You're working, you're putting money away. You're doing that on a regular basis over that extended period of time. Well, guess what? When you get to that last third of life, you're going to be taking that money out over that entire period of time, not all instantaneously. So be very, very careful on the information that you're getting from the media and make sure you're not turning the apple cart upside down. So some thoughts and perspectives on the week that was certainly a rough week, all part of the normal behavior of the market. On average, you see these declines of 5-10% at least once per year, even though the overall trend of the market is still up. And stay tuned, because as we were mentioning before the break, one of the things that we talked about 2-3 weeks ago on the program was about midterm elections. and the takeaways from that. One of the key takeaways is that if you look at midterm election years, you will see an increase in volatility. Said it on this very program, increase in volatility in the weeks leading up to midterm elections. What do we have? An increase in volatility. Midterm elections happen. There's resolution on that. And what happens, if you look at the prior history, you've got the third year of the presidential term coming up. In this current case, you've got a relatively strong economy, consumer spending, corporate spending, all looking relatively strong. And so when you look historically at that 12-month period following midterm elections, the returns on average have been about 15%. So we will hope that the pattern continues to hold true. Interestingly, the pattern so far this year in a midterm year is holding very much true to prior midterm years. Year is typically marred with a decline early on, which was what happened in January, February, then followed by a market going basically sideways for the rest of the year, and then volatility kicking up just prior to the election. So all three of those, check the box, we've seen them repeat this year to follow the same pattern that we've seen in midterm election years. So some interesting stuff on that. Speaking of patterns and how you want to be looking at performance, one of the things that we are seeing as we track the performance of funds, and not only the funds that we recommend, but also other funds as well, to kind of gauge the universe as a whole, you've really got to be careful at what number you are looking at these days, because what's happening on the 10-year number, the 10-year annualized number, is those 10-year annualized number, if you track them on a daily basis like we do, that 10-year number has, over the course of the past week or two, has really jumped dramatically to a much higher number. Because what happens on a 10-year performance number on a fund is it looks back from today's date, going back 10 years. As we get deeper into October, what's happening is you're losing the first part of October of 2008. So be careful when you look at the 10-year number now on a fund, because it doesn't really reflect the full market cycle. Which goes to our point, which is something we say all the time in the office, and we'll say it here on the radio program. I don't know how you use a fund that hasn't been around for at least 20 years. That is our screening process that we use internally at the office. And I don't know how you use something that's got less than a 20-year track record, because what's happening with these numbers? 2008 is falling off the 10-year number. I mean, it used to be that a 10-year performance number, okay, yeah, that's a fund that's been around a while. Not so much anymore. Not so much anymore, because as we're seeing right now, the 10-year annualized number, the 10-year performance number on a fund over the course of the past 2 weeks just shot up by anywhere from 2 to 3% on an annualized return. Let me repeat that again. 2-3 weeks ago, annualized numbers were in the neighborhood of 7 or 8% or on a 10-year trail. Now, those numbers have literally shot up to 10 to 11% within 2 weeks. Within 2 weeks. So be careful as you're looking at the performance of the funds these days and looking at the 10-year number. It will tell you a story that is not as accurate as we believe the story should be, simply because how the calendar falls. As we get deeper into October, we've already lost the single worst week in the market that occurred during the decline of 2008, which was the first week of October, when the folks in Washington, in their infinite wisdom, voted down the original TARP, the bank bailout bill. Okay, only to 5 days later say, oh, market's down 20%. Maybe it was a bad idea that we voted against that. Let's have another crack at it. And then they finally, on that Friday, voted for it. But in those 5 days, there was a 20% decline in the market. That 20% decline now is not in your 10-year performance number. So you really got to look at 15-year numbers or 20-year numbers to gauge how a fund will do throughout the cycle. Because the 10-year number is very deceiving now. We've seen that jump in the course of the past 2 or 3 weeks from about 7 or 8 to 10 to 11, close to 11. So be careful as you're looking at your performance numbers. You really want to dig down a little bit deeper into these numbers because of how the calendar falls. This is really kind of one of the most dramatic shifts that we've seen in the performance numbers probably ever, because of the dramatic decline that happened in the first week of October of 2008. We'll continue a little bit more on this topic just so you all understand it and make sure that you understand what it is that we're driving at here. So stay tuned through the break. We'll talk a little bit more about this, and then we will shift gears to how your portfolio manager is compensated. We'll cover all of that when we get back here on Dollars and Cents. This is Joel Garris of Nelson Financial Planning, News Radio 93.1 WFLA.
This is Bud Hedinger. You know, you can talk to Joel Garris of Nelson Financial Planning right now on Dollars and Cents about anything to do with your money by calling 407-916-5400. Give him a call. It's time to make sense of your dollars.
Welcome back to the program, ladies and gentlemen. Dollars and Cents. This is Joel Garris of Nelson Financial Planning. You're listening to News Radio 93.1 WFLA. On the program so far, of course, we've tackled the market that was this past week, a relatively rough one in a lot of ways. Bottom line, remember, okay, this is a marathon, not a sprint. Do not take your investment allocation and turn the apple cart upside down, so to speak. Look at it, make some adjustments if you need to, but do not turn it upside down. This is all part of the normal process. This happens. This is all normal. This is not what the media and the internet would have you believe, that there is some impending catastrophe around the corner, because they always believe that. They always push that. And the reality is, when you take a step back and look at market performance over the course of the past 80 years, you will find nothing better to achieve long-term investment results, simply put. Speaking of long-term investment results, we were talking a little bit about this before the break. The 10-year number, the traditional number to look at, if you will, in terms of performance, is really not a good number to look at these days, because it is getting skewed dramatically because of how the calendar falls. The 10-year trailing number measures the period back 10 years. Unfortunately, as we get deeper into October, the reality is that you lose the first week of October of 2008, when the market did most of its decline, actually, in that 1 week period of time, first week of October 2008. Which means that your 10-year number is really getting skewed right now, whereby 2 weeks ago, the 10-year number, which had a lot of the 2008 decline in it, making it a somewhat worthwhile number to look at, was around 7 or 8%. Now, 2 weeks later, that number has jumped up to 11%, 10 to 11%, depending upon what the type of fund is that you're looking at. Well, is that sort of skewing the bottom line results? Of course it is. You better believe it is. So when you look at that number, you can no longer really rely on the 10-year number to give you an effective gauge of the performance of a fund through a full market cycle. And folks, we would stress to you that that's an important barometer to look at, is to look at what the fund has done through a full market cycle. Ups, downs, sideways. Because that helps to then give you a number that you can sort of to plan on from an investment perspective. But right now, that 10-year number really is skewing incredibly, incredibly high. And frankly, if you've got a fund with less than a 10-year track record, then you have no idea. You have no gauge. You have no perspective on how that fund actually performed when times got tough. And I would submit to you that that's a pretty important, perhaps the most important piece of information to know about your investments. How do these things do when times get tough? Because at the end of the day, that's going to make a big difference. So be very careful as you're looking at funds these days. The 10-year number, no longer a good number because it is skewed dramatically to the positive. And we're going to continue to see that number continue to get skewed as we go forward over the course of the next 3 or 4 months. Remember, the market in 2008 did not bottom until March of 2009. So you've got between now and March where that number, that 10-year number, is going to get progressively better. And look, progressively better, but it's going to be a very skewed result. So in order to get a true result, you've really got to start looking at the 15-year performance number in order to see exactly what went on during that period of time. So remember that, because that's going to be pretty important in terms of gauging performance and how funds have actually performed during a full market cycle. And speaking of funds, one of the most interesting parameters to put into play when you're looking at a fund, particularly a managed fund or particularly an active fund, is the compensation structure of the portfolio management team who is in fact operating that fund. Okay? And why is that important? Because if your portfolio manager is paid more on the short-term basis, then what you have is a fund that's not really investing. What you have is a fund that is trading. And trading is no way to achieve investment results over time. So one of the biggest things you can ask, or you can find out, if you're working with somebody, you need to ask them this question. If you're not, then you need to call the 1-800 number and ask them this question. How is the portfolio manager that is running these investments, how are they paid? Folks, the statistics will in fact shock you. 80% of portfolio managers make more than half their compensation on a 1-year performance number. Let me say that again. 80% of portfolio managers make more than half of their compensation on their 1-year performance. I'm sorry, but that's not rewarding investment results. That is rewarding timing. And it's a problem that's pervasive in the mutual fund industry, and it's one of the biggest reasons why most mutual funds don't perform very well. There's 11,000 different mutual funds out there. The mutual fund industry has a bad rep because the vast majority of them don't do very well at all. They're internally expensive. They have funds, clearly. The management team is being incentivized, is being paid to make short-term trading decisions to boost performance. Because let's face it, human beings always act in the best interest of their wallet. So if your compensation is tied, the majority of your compensation is tied to what you did over the course of the past year, what do you think you're going to do? What do you think you're going to do as, you get to the end of the year? Okay, maybe lagging a little bit behind. Oh, I'm going to start trading. I'm going to start trying to go swing for the fences, if you will. The only problem is when you're swinging for the fences, that's also when you have a tendency to strike out, which is why so many mutual funds underperform the market, is because the compensation system is wrong. It doesn't reward investing. It rewards trading. And that's one of the biggest underlying issues that you probably don't hear much about, because nobody wants to talk about compensation and how the portfolio managers are compensated. Nobody wants to talk about it. Okay, but we think it's a pretty important thing to look at and to ask. It's a question that we ask regularly of the funds that we recommend to our clients. It is a question that we ask regularly because we want to make sure that if you're managing investor money, that you're incentivized and paid to be an investor, not a trader. Because trading never works to produce good investment results over time. So that's one of the many questions that we ask when we're trying to decide what funds to recommend to our clients. It's very important to know how the portfolio management team is actually being compensated. The statistics and the numbers suggest that the vast majority of funds, portfolio management teams are compensated. Majority of their compensation is based upon a very short-term 12-month track record. Those are the kinds of questions that you want to ask when it comes to your investments and your money to make sure that the interests of that fund and that portfolio management team are aligned with your interests. We'll have more when we get back here on Dollars and Cents. This is Joel Garris of Nelson Financial Planning on News Radio 93.1 WFLA.
This is Bud Hedinger. You know, you can talk to Joel Garris of Nelson Financial Planning right now on Dollars and Cents about anything to do with your money by calling 407-916-5400. Give him a call. It's time to make sense of your dollars.
Welcome back to the program, ladies and gentlemen. Dollars and Cents here on News Radio 93.1 WFLA. My name is Joel Garris with Nelson Financial Planning. I am the host. We're talking about a whole host of stuff on the program today. If you missed it, well, the good news is that you can always listen to it again. We post it on the various social media channels, YouTube, Facebook. And now I've run out. It's like 8 of them. So let me see. It's YouTube, it's Facebook, it's iTunes, it's, I'm probably going to have to look it up. It's pretty much every one of them known to LinkedIn, and it's a bunch of them. I really should know off the top of my head. Again, as I said earlier in the program, got a guy half my age. He does all that stuff at the office, right? Anyway, the reality is that we do post the program on the various social media outlets. To find the links directly to go to where we post it on SoundCloud is another one of them. Is you go to our website, www.nelsonfinancialplanning.com. In the upper right-hand corner, you'll see all the various icons. Click on the one that looks familiar to you, and it will immediately direct you to our channel where on that particular media platform, whereby you will be able to listen to the program. But certainly, we've recapped the week that was a tough week for sure, but not a situation where you would turn the apple cart upside down in terms of your investments. And then talked a little bit about the 10-year number and versus the 15-year number. Really have got to start to look at the 15-year number as a true barometer of the performance of a fund over the course of a full market cycle, particularly all of 2008. If you don't own funds that have at least a 15-year track record, well, then I might suggest you look for something else. And then we talked a lot about compensation. If you own funds, how are the people that manage those funds being paid? It would surprise you to learn that in the industry, the mutual fund industry, 80% of portfolio managers make more than half of their compensation on the 1-year performance. That, folks, is one of the biggest issues inside the mutual fund industry and why the mutual fund industry generally does not do as well as it should in terms of its performance. Because if you're incentivizing portfolio managers to only have a 12-month track record to make their majority of their compensation, then you are incentivizing people to be traders and not investors. That's a question that we ask. That's a piece of information that we know about all of the funds that we recommend at the office because we think that's pretty important to know. Okay, the 1-year number does not make that big of a difference. How about the 3-year? How about the 5-year? How about the 10-year number? Even longer than that, the lifetime number since that person's been at the helm. That's a much better way to make sure that your interests are aligned with the funds that you own. Because at the end of the day, you're investing for the rest of your life. You're not trading, or you shouldn't be trading. So make sure that the fund matches up with that. On another note, one of the things that you're going to hear us talk up a lot about over the course of the next 2 or 3 weeks is to try and break down this conversation that to a large extent revolves around the fiduciary rule that was proposed for the financial services industry. Certainly, it's a rule that we fully support. And frankly, wish it had come around a much longer time period ago, and could serve to be a little bit more expansive to pick up, in particular, the insurance folks, the annuity folks, particularly these folks that are doing these equity indexed annuities. You get all of the upside of the market with none of the downside risk. Yeah, I'm sorry if you've believed that pitch line, because the reality is it doesn't quite work out that way. But anyway, I digress. The fiduciary rule, a very good standard. And what's interesting is the industry as a whole, as we've just talked about with the mutual fund industry, the industry as a whole, unfortunately, often does not have investors' best interest at heart. And they take these things like a fiduciary rule and they flip it, okay, to the point where they're able to then make more money, even though we have this conversation happening in the mainstream media about how investments are supposed to be made, okay, solely in the best interest of the client. That's a fiduciary standard. Okay, so you would think, right, if now the industry is aligning to this platform where it's a fiduciary standard, that your costs would go down. Well, guess what? That has not happened. In fact, your costs have gone up, and the industry, and I'm going to give you the statistic, and when I heard it, it blew me away. The industry as a whole has taken advantage of the conversation and rolled out all this fee-only conversation, right? This fee-only conversation says that if you are not compensated on a fee-only basis, then somehow the advice that you're giving is not in the best interest of the client. The problem is you only need to look so far as to figure out how the financial services industry is warping that concept by simply looking at the profit margin of the large broker-dealers. So we'll talk about that. Prior to the fee-only conversation, to the fiduciary conversation, the profit margin at most large brokerage firms was a mere 8%. 8% is still pretty good, okay? But it was 8%. Take a guess as to what the profit margin is now. It's 28. It's gone from 8 to 28 with the whole introduction of this fee-only mantra. Fee only. You must go to somebody that only will charge you a fee, because that's the only way you're going to get clean advice or unbiased, unvarnished advice. Yeah, right. Okay? That is positioning by the financial services industry to effectively create a bigger cost to you, the investor, and a higher profit margin to the brokerage industry. You don't go from an 8% margin and then roll out fee only, and that's going to be in the best interest of the client, and then your margin is 28? Come on. Folks, if you're an investor, those are the types of questions you got to be asking. What's the total all-in cost of this approach? You got to total it up. You got to come to that answer. Otherwise, you're just going to help the profit margin of the large brokerage firms. It's a pretty big jump, 8 to 28, all as a result of going to a standard that was supposed to be in your best interests. Tell you, okay, the more I'm in the financial services industry, the more ashamed I am to be in this industry. Because there's no desire to be in the best interest of the client. It's all what the profit margin can be. Just unbelievable. Anyway, I didn't get to the Social Security stuff. We'll table that. We'll shift that to next week. Thank you all for listening to the program. We've got to wrap it up and get on out of here. This has been Dollars and Cents with Joel Garris of Nelson Financial Planning on News Radio 93.1 WFLA.
This is Bud Hettinger, and you've been listening to Dollars and Cents with Joel Garris of Nelson Financial Planning. If you missed any part of today's show or want to listen to it again, check out the radio show at www.nelsonfinancialplanning.com or connect with them on Facebook or Twitter. Be sure to call Joel this week at 407-629-6477 to schedule your free consultation to discuss your retirement plan.